Most people think options trading is complicated, full of jargon and charts. But here's the twist. You have probably been trading options your whole life. You just didn't call it that. Every time you buy car insurance, you are actually buying a put option. You are protecting yourself against loss. Options aren't just for Wall Street, they are part of our everyday life. Welcome to Financial Flywheel, where we support and encourage you to design, nurture, and run your own financial flywheel and move towards financial freedom. Today, let's understand options without the scary financial language so you can see exactly how they work in the markets too. Carol needs to have a car insurance. She's a owner of a Tesla sedan in Lynchburg, and there are a lot of thoughts that are going on. What is going to cost me each year? Option premium. Can I afford it comfortably? If something happens, how much will they actually pay me? Which is the insured declared value, the maximum claim payout. Will they cover just accidents or also theft, fire, floods? What will I have to pay from my own pocket? The deductibles and excess, the copay in car language. How quickly will they help me get back on the road? The claim settlement speed and the garage network. Do I get any extra perks, any roadside assistance? She's talking about the zero depreciation cover, personal accident cover, and perks of that nature. Can I trust them? She's asking about the reputation, customer reviews, and claim approval rate. So these are all valid questions that run through her mind. But one thing we should remember is that when it comes to insurance, she is not just buying a piece of paper, but buying peace of mind. But the brain, if you notice, is not thinking in terms of policy clauses. It is just asking simple questions. And it does not know that it's actually looking at an option situation. Meanwhile, few months back, Suresh has joined to lead the motor insurance division of a mid-sized insurer in Lynchburg. One morning, he gathers his data analytics team in the meeting room and says, "Team, we are about to roll out our insurance product for Lynchburg. But before I can get and set the premiums, I need the numbers that tell me the real story. So, guys, step one, find the past. Pull the last 5 years of claims, the data for cars registered in Lynchburg, the accident reports, repair invoices, total loss payouts, and just filter it by car make and model, year of manufacturer, driver profile, type of road accidents. Okay, that will be it. After that, it is time to move to step two, which is we need to spot the risk. From the filter data, guys isolate only the cases where a claim was actually made. Then plot the claim amounts on a chart. I want to see the distribution. Well, that's our bell curve, team. Step 3, read the curve now. When you plot it, thank you team for plotting it, the peak will show me the most common claim size in Lynchburg. The tails will tell me about the rare but high value claims which can lead to total losses of the car and hence compensation, maybe flood damage, multi-car pileups, etc. Let us address the tail risk. Remember, we are not covering black swan events like a natural disaster that wipes out thousands of cars in Lynchburg at once. Suresh tells the team. Those are beyond the scope of the policy. Removing such extreme events from our data set ensures the bell curve reflects realistic insurable risk, not catastrophic outliers. Okay? Fine. Now team, let's go to step 5. Let us calculate the expected loss. What percentage of insured cars file a claim each year? The average payout of these claims. Now let us multiply those, find out our expected cost per year per car. Then let's add real world factors like Once I have the expected loss, I'll add our admin cost, risk buffer for bad years, some profit margin. That final figure is the premium we can confidently quote for Lynchburg. Suresh smiles once again and says, the customers will see a number. We will see the curve behind it. Get me the curve, and we will set a price that's fair for the customer and sustainable for us. So, when Suresh and his team do the data analytics and come up with a bell curve, he notices that the probability of the claim is approximately 6%. And the mean claim, if an accident were to occur, is approximately $4,200. With this, he comes up with the premium cost. Now, let us go back to our initial scenario. Carol's car insurance needs to be taken. So for that, she goes and clicks on her app to determine what exactly is the premiums that are available in the market and which is the brand that she can trust. So for that, she compares the quotations that are there and notices that the premium that Suresh's team were to offer is the best one that suits her budget, as well as the services that are offered also falls into her expectation. Now let us closely look at how we can parallelly compare the data that Carol has analyzed with that of how an options trader would look at it. In this context, there's an underlying asset. In her case, it is this red Tesla sedan. In the context of the options world, it is called as the underlying. The type of option is a put option. And there are ways in which a person can participate. In this case, the Carol is the put buyer and Suresh's org is the put seller. When Suresh sells the put, it is called as shorting the put or writing the put. And in the context of Carol, it is she is a put buyer or she has gone long on a put option. Strike price is a terminology that is used in the world of options. In this case, it is the insured value of the car or the maximum IDV, which is $42,000 in this particular case. In the context of the options world, the strike price is the price at which the risk actually occurs in the real world scenario of the options. The premium, in this case, is the annualized premium that is paid to the insurer and it is paid upfront. In the context of this analogy, it is around $358. In the options world, premium is paid by the buyer when the trader buys the option. The duration or the validity of the contract, it depends on the tenure. It can be a day, a couple of days. In the context of US, almost every other day you have a contract. In the context of India, the minimum is 1 week. In the context of US, you can have up to several years an option as a buyer. Similarly, as a seller, you can sell an option for a certain premium. And in this context of the insurance case, we have Suresh selling a premium for 1 year. Then expiry date is suitably calculated. And then we have a payoff. Payoff is something that is a terminology used in the options world, which will tell in the event where a scenario of a buyer, the strike price has been hit, what is the money that the buyer can expect from the option seller. So we will go through that in a bit detail, but that is the significance of the term payoff. and then you have something called an excise or trigger condition. Well, in the context of the options world, when a strike price is hit, then the trigger is or the excise condition is begun. In the context of the insurance, we have an accident to occur before the expiry. Of course, in the options world also, all this should happen before the contract expiry. Now, what would happen if the option has been bought by Carol and she does not make a claim, meaning no risk were to ever occur during that 1 year? Then the premium is given, and she is happy that she didn't go through an accident experience, and that's about it. In the options world, if the buyer of the premium, of the insurance, of the option, sorry, is not able to exercise the option, he will no doubt lose the premium amount. But nevertheless, it is possible that this is a cost that he would need to adjust in some other place so that it is possible for him to sustainably buy options. We will go through that topic in a bit more detail when we come to options designing or models designing. Now let us look at the entire scenario from Carol's perspective. Well, Carol being Carol, she wouldn't notice this, but if Carol were to be an options trader, this chart shows the potential net benefit from her car insurance policy. The IDV is the strike price. Along the bottom, we have the accident cost from 0 to 60,000. On the vertical axis, we have Carol's net payoff after paying the premium. Scenario 1, if there is no accident, Carol's payoff is negative because she has paid this $358 as premium. This accident cost is deductible if the accident cost is less than her $500, which sometimes these insurance policies do charge as a minimum deductible. Now, between this deductible and IDV, now let us look at the worst case scenario. Say up to $42,500 if that were to go. Then, because $42,000 is the cost of the car and $500 is the deductible that any which way she has to pay. So that is the maximum payout limit, which you can see, which is tapering on the top of the graph. So in her case, what has happened is she has $42,000 paid and the initial premium amount that she has paid. So once those two are adjusted, we can determine what is the maximum payoff that she can expect, which is $41,642. So let us look at it in conclusion. The put option is now in your driveway. When Carol bought her car insurance, it felt like the most ordinary thing in the world. Families everywhere do it. But paying a premium, getting a policy, tucking it away in a file, and hoping that they never have to use it. But today we have peeled back the curtain. What is looking like a household decision in financial terms, it's actually she has bought a put option. Carol, the buyer of the option, knows the premium for the right, not the obligation, to sell her loss of the car to the insurer if an accident risk were to occur. Now, the terms that I'm using over here are typical terms that sounds treacherous and complicated when we look at it from the parlance of options. But that is the way it is designed. Behind the scenes, Suresh team has built a bell curve from years of claim data, removes the extreme tail events like natural disasters through condition supply clauses, and calculates the expected loss. The curve tells them how often does a scenario occur, what is the realistic worst case, they add expenses or profit margin, so that the price that Carol sees is actually the premium that consolidate all this information in the data. Now, this is a perfect meeting of everyday life and financial theory. And the next time you renew your insurance, you might just smile knowing you have made an options trader. You have been an options trader all along. You just called it protecting the family car. Thank you for your time. All the best for all that you're doing. Until we meet next, bye for now.